Earnings before interest, depreciation, and amortization, EBIDA, is a financial metric that represents a company's profitability from its core business operations before deducting interest expenses, depreciation, and amortization. It provides insight into a company's ability to generate profits from its primary activities, excluding the effects of financial leverage and non-cash expenses related to asset depreciation and amortization. Key points about earnings before interest, depreciation, and amortization, EBIDA, include 1. Calculation. EBIDA is calculated by starting with the company's net income and then adding back interest expense, depreciation, and amortization. The formula for EBITDA is as follows. EB equals net income plus interest expense plus depreciation plus amortization. 2. Focus on operating performance. EBITDA focuses solely on a company's operating profitability, excluding the impact of interest expenses, depreciation, and amortization. By focusing on core business operations, EBIT provides a clearer picture of how well a company is performing in generating profits from its primary activities. 3. Usefulness for comparisons. EBITDA can be useful for comparing the operating profitability of companies within the same industry or sector. Since it removes the effects of financing decisions and non-cash expenses related to asset depreciation and amortization, EBIDA allows for more accurate comparisons of operating performance across companies with different capital structures or accounting methods. 4. Decision-making. EBIDA provides valuable information for decision-making by management, investors, and creditors. It helps management assess the effectiveness of their operational strategies and identify areas for improvement in generating operating profits. Investors and creditors may use EBIDA to evaluate a company's ability to generate cash flow from its core business activities and assess its financial health. Number 5. Limitations. While EBIDA offers insights into a company's operating profitability, it is not a comprehensive measure of financial performance. It does not take into account non-operating income or expenses, such as gains or losses from investments, one-time charges, or extraordinary items. Additionally, EBIDA may vary depending on the accounting methods used by a company, making comparisons between companies challenging. 6. Relationship with EBITDA. Earnings before interest, taxes, depreciation, and amortization. EBITDA is a related metric that further removes the effects of interest and taxes from EBIDA. EBITDA provides an even clearer view of a company's operating profitability by excluding non-cash expenses related to asset depreciation and amortization. In summary, earnings before interest, depreciation, and amortization, EBIDA, is a useful measure of a company's operating profitability, providing valuable insights for decision-making and comparisons within the business community. By focusing on core business operations and excluding the effects of financial leverage and non-cash expenses, EBIDA offers a comprehensive view of a company's ability to generate profits from its primary activities.